Ways debt can make you money. Ways debt can make you money. Many individuals are terrified of the term debt. There are a plethora of television shows, books, and periodicals dedicated to helping individuals get out of debt. While debt can be viewed as a bad factor, it can also be beneficial when utilized correctly. The most common way to utilize debt to invest favorably is to employ leverage to raise your profits tenfold. What precisely is leverage? Using borrowed funds to boost your return on investment is known as leverage. Leverage can help you reach returns you never thought imaginable, but at the cost of a higher danger of losing your money. Here are 5 ways that debt may make you wealthy through leverage. Takeaways important. Although debt is commonly thought of as a negative indicator, if handled and managed effectively, it may be a positive one. Debt may be used as leverage to increase an investment's profits, but it also increases the risk of losses. Margin investing is when an investor borrows shares for a higher price than he or she can afford in the hopes of stock gain. ETFs that utilize leverage to match an index are known as leveraged exchange-traded funds, ETFs. Many hedge funds employ leverage, but they're usually only available to the wealthy. Borrowing stocks with the expectation of a decline in the security borrowed is known as short selling. With a modest amount of money, investors may control vast blocks of currencies through forex trading. Investing on the margin. Investing on margin allows you to acquire more shares at a lower price than you have available cash. For example, if you have $50,000 in a standard brokerage account, you might create a margin account to leverage your investment. A margin account permits you to put up a maximum of 50% of the stock's purchasing price. You would have $50,000 in cash and your broker would loan you an extra $50,000. Your $50,000 investment provides you with $100,000 in purchasing power. You could invest $100,000 in shares with this money. You can pay back the loan and pocket the profit if the stock price rises. The disadvantage is that if your account's equity falls below a specific level, your brokerage company may issue a margin call. If you don't have enough money to make your margin call, your broker might liquidate your whole stock investment, leaving you with losses. ETFs with a high leverage. ETFs that are leveraged allow investors and traders to increase their returns by going long or short on a certain index. Leveraged ETFs, such as those offered by ProShares, allow investors to increase their gains and losses by 200 to 300%. 1. You can invest in particular indices, bonds, commodities, or sectors using these funds. The huge profit potential of leveraged ETFs makes them appealing. With leveraged ETFs, you may reach returns that other investors only dream of during market booms. The difficulty is that leveraged ETFs may work against you in the same way they can work for you. Leveraged ETFs may exacerbate losses by wiping out your whole investment in a few days unless you are an expert at trading in and out of these products. Hedge funds are a type of investment firm that invests in. Hedge funds are among the most heaviest leverage users. They are well known for exploiting leverage to generate abnormal returns. Hedge funds sometimes leverage up to 10 times their entire assets. John Paulson, a multi-billionaire hedge fund manager, has leveraged leverage to make authorized investors into multimillionaires. However, if the fund manager's investment thesis is incorrect, the hedge fund may go out of business and all investors' money would be lost. Hedge firms that needed bailouts, such as long-term capital management, LTCM, were leveraged up to 30 times their assets. Short-term investing. Have you ever seen a financial show on TV and been told that now is the time to short the market? Short selling is a common strategy to wager against a security by borrowing shares from an investor and selling them in the expectation of a price drop. Short sellers have made a fortune by correctly timing stock price falls. Short selling has the disadvantage of having no limit on losses, which implies that short sellers might lose considerably more than their initial investment. Trading in the foreign exchange market. With a modest amount of money, investors may control vast blocks of currencies through forex trading. Currency traders can have a 100-to-1 leverage on their accounts. Currency trading has the advantage of allowing you to swiftly change a little bit of money into a large sum. George Soros is regarded as the guy who ruined the Bank of England. having made a fortune of $1 billion by betting against the pound. Currency trading, on the other hand, has the ability to wipe out a trader's account in a matter of minutes. Final thoughts. It may go against popular belief that debt has a negative impact on a person's finances, but when handled effectively and managed properly, debt may allow people to make purchases they wouldn't otherwise be able to afford, greatly increasing their returns.